This is Poolside Chat, and I'm your host, John Woodward.
The most significant comment I hear from people looking to buy is that they're waiting for prices to come down or for the market to crash. The price increases we saw over the past few years were spectacular and, of course, not sustainable. Interest rates began to increase in early 2022, putting the brakes on an overheated market. The first thing many start thinking is that the market will crash as it did in 2008. The foundation or run-up to the crash of 2008 versus today is quite different, and a crash is doubtful. Supply and demand govern market prices. Low interest mortgages allow home buyers to pay higher prices when the money is cheap, and it helps to increase the demand. Florida is a desirable destination due to the warmer climate. We also have no state income tax, and there's a general feeling that Florida is a well-run state. Pair that with the ability of the workforce to work remotely, and it's no surprise that between 800 and 1,000 new people become Florida residents every day. Demand remains strong. Home purchases over the past several years are evenly split between all cash and finance purchases. In the years leading up to 2008, cash purchases were only 15% of total sales. Financed homes today typically have larger down payments than the loans before 2008, so owners of financed homes today have more skin in the game. The lessons of the 2008 crash eliminated 80-20 loans. Essentially, these loans were 100% financing. Pick-a-pay and negative amortization loans were also common. Home prices rose because mortgages were easily obtained with little or no money down and lax borrowing standards. The thinking was that rising prices would offset increased mortgage balances common with the negative amortization loan. However, when values level off or go down, the losses accumulate quickly, and markets do not go up forever. When prices started to level off, owners found themselves upside down, and many decided to walk away from these properties to let the bank take them through the foreclosure process. It turned a cyclical market correction into a catastrophe by adding a glut of short sales and foreclosures to the supply. With half the homes over the past several years bought for cash or finance with higher down payments, the underlying foundation of this market is much stronger than the years before 2008 crash. Just remember, interest rates were also at 6% then as they are today. Another unmentioned carryover from the 2008 correction that still affects the market today is new home construction. It peaked at 2.4 million starts as of January 2006. The most recent peak was almost 1.8 million home starts in February of 22. Housing starts are about 23% below 2008 levels. Post-COVID supply chain issues linger and restrict supply. Demand for building materials in portions of South Florida still exists due to the recovery effort from Hurricane Ian. In other words, the supply of new homes has yet to achieve the levels of 2007. Still, according to the latest 2022 census reports, Florida is the #1 state for net population gains from the Great Migration. Again, the balance between supply and demand dictates market prices. The mistake some are making is that if national real estate numbers are down, Florida must be down too. Florida has certainly slowed, but market prices are relatively flat. The current higher mortgage rates holds prices back, but the supply and demand balance keeps prices from falling. The effect of a slowing, more normal market is that multiple offers and bidding wars are less prevalent than in 22. Buyers can negotiate and finance and do not have to waive inspection or appraisal contingencies. Even so, I regularly see some homes go pending in a few days, and several buyers I have are waiting for inventory in specific areas to become available. Sellers are generally negotiating, but there are areas within our very economically diverse market with bidding wars because of a tight supply. Marketing times are generally longer, which allows buyers time and leverage when negotiations occur that they did not have last year. Market inventory in January was about 2.8 months instead of 0.6 months in 22. A balanced market has about 6 months supply. The broad Sarasota area market peaked in July this year with an average sales price of $717,000. The average for January of 23 inched back up to $674,000. While financing costs more, buyers can negotiate price and or closing costs that can help to offset some of the increased payment. Every situation is unique, and Sarasota has several markets due to the economic diversity of the population. Broad market numbers are interesting, but analysis of your specific market helps avoid leaving money on the table. That's what I do. Sellers are generally the last ones to get the memo that prices are not up like they were last year and tend to overprice their homes, so there are a lot of price reductions. On average, sellers will sell in 30 days or less once pricing is in line with the current and not the hoped-for market. Knowing the market direction is going to be key this year. Comparing short and longer time frames is where I usually start. Market statistics are usually 2 months or an entire quarter behind where the market is today. Here's a screenshot of the 7-day market view, critical to understanding the now market compared to a longer term view. I add the new and back on market counts, and then I subtract pending, expired, withdrawn, and canceled categories. Solds don't count because all properties become pending prior to being sold, and price changes don't affect inventory levels. This is one of the areas of the market I track, and it helps me to keep buyers and sellers best advised. If the number is negative, the supply decreases. Positive numbers mean more inventory. In this case, the active market has 68 fewer, or about 4% less active listings over the past 7 days. 4%, 4 weeks in a month, and in theory, that's a 16% change or fewer homes on the market, which is significant. In many ways, buying a home now is easier than a year ago. Last year, there were 15 offers on every home, meaning 14 people came away frustrated and empty-handed. Higher rates tend to push prices down, but the supply and demand balance still favors higher prices. It's really a tug of war. Hopefully, most of the significant interest rate hikes are behind us, and locking down a price now with the potential of refinancing at a lower rate in the future is something to think about. Some analysts predict the Fed will lower rates by as much as 2% by year's end. A lower price today and a better refinance rate tomorrow is something to consider. Feel free to leave me a comment below, or if you have any questions, reach out to me and I'll be sure to get you answers. I'm John Woodward, and you make it a great day.